Hey everyone, welcome back to Corporate Decoder. Today, Caro Holdings Inc. CAHO just filed an 8K about a new deal, and I'm seeing a bit of a gold rush angle here that could pay off big, or not at all. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company looks to be buying a significant stake in mining rights in Tanzania, and the details of that deal are pretty interesting. So what we have here is a report from Caro Holdings Inc. filed on the 12th of June 2026. This document is called a Form 8. Think of it as a public announcement for really important company news that isn't part of their regular scheduled reports. It's like the company is tapping us on the shoulder to tell us about something major. This particular 8K is all about a big agreement Caro Holdings Inc. just made. They are buying into mining properties, which is a pretty significant move for a company that seems to be in the broader industrial or specialty business services sector, with a market cap around $14 million. Let's get to the heart of the matter. The company Caro Holdings Inc. on the 9th of June 2026 made a deal with a company called Goldrange Resources Corp. Goldrange is based in Canada, and what Caro Holdings Incorporated is doing is buying a 49% undivided interest in Goldrange's rights to some mining properties. These properties are located all the way over in Tanzania, Africa. Now, how are they paying for this piece of the mining action? They are not handing over cash. Instead, Caro Holdings Incorporated is going to give Goldrange Resources Corp a hefty chunk of their own stock, precisely 20 million shares. This is a common way for smaller companies to make acquisitions, especially when they might not have a lot of ready cash. It's essentially swapping ownership in one company for ownership in a mining asset. The agreement itself has all the usual legal safety nets you'd expect in a deal like this. Think of it as the fine print that protects both sides. It covers things like promises about the truth of information shared, ongoing duties, who pays for what if something goes wrong, agreements to work exclusively with each other on this front, and conditions for ending the deal. This next part explains why issuing those 20 million shares is allowed without the company having to go through a big, formal registration process with the government. Basically, they are using a specific exemption, Section 4, R2 of the Securities Act of 1933. This is typically for private placements, meaning they are selling these shares to a limited number of sophisticated investors. In this case, Goldrange Resources Corp, who likely don't need the same level of information as the general public. Because these shares are being issued in this private way, they will have a special note on them called a restrictive legend. This is like a sticker saying these shares cannot be easily resolved to just anyone right away. They are restricted, meaning there are rules about when and how they can be traded to comply with securities laws. This section just tells us what other documents are being filed along with this main report. The most important exhibit here is Exhibit 10.1. This is the actual full asset purchase and acquisition agreement between Caro Holdings Incorporated and Goldrange Resources Corp. This is where all the nitty-gritty details of the deal are written down. And finally, we have the signatures. This confirms that the company has reviewed and authorized this filing. It is signed by Merisha Reynolds in her role as president on the 12th of June 2026. Let's look at this from a bigger picture. Caro Holdings Incorporated, with a market cap of about $14 million and a stock price hovering around 39 cents, is making a play for a nearly half stake in Tanzanian mining rights. This is a classic growth strategy for smaller companies acquire assets that have the potential for significant upside. Consider a company like Gold Corporation back in its earlier days. They were also focused on acquiring mining assets. When these exploration and acquisition plays work out, the stock can see massive gains moving from small to mid-cap status. However, the flip side is equally stark. Mining ventures are incredibly risky to ease the cost and complexity of exploration. The potential for discoveries that yield nothing, political instability in the region, environmental concerns, and the sheer difficulty of extracting resources profitably. Many mining ventures end up being expensive lessons learned, rather than lucrative ventures. This particular deal involves issuing 20 million new shares at a stock price of $0.39. That represents a significant amount of dilution for existing shareholders. Imagine a pie cut into 100 slices. Now, you're adding 20 more slices to that pie and giving them away. Each original slice becomes a smaller percentage of the whole pie. Historically, companies that undergo substantial share issuances like this, especially when they are in speculative sectors like junior mining, can see their stock price come under pressure in the short to medium term as the market digests the increased supply of shares. The mention of unregistered sales of equity securities and reliance on Section 4, A2 is important. It means this deal is not being fully vetted by the public markets in the way a registered offering would be. While this allows for speed and efficiency, it also means Goldrange Resources Corp might be acquiring these shares with the intention to hold them for a period, or perhaps they will be looking to sell them down the line, which could put more selling pressure on the stock. What I am seeing here is a high risk, high reward situation. Caro Holdings Incorporated is betting that these Tanzanian mining rights will be a game changer, something that could transform the company from its current small cap status into something much larger. The gamble is whether these rights will actually yield valuable resources. The 20 million shares issued to Goldrange are a significant dilution. It reminds me a bit of speculative biotech companies that issue large amounts of stock to fund clinical trials. A successful trial can lead to massive gains, but more often than not, the trials fail and the stock loses most of its value. Looking at past microcap deals involving resource acquisitions, it is not uncommon for these types of transactions to result in either spectacular success or significant value destruction for existing shareholders. The biggest risk here is that the mining rights prove to be less valuable than anticipated, or the cost of extraction becomes prohibitive. If that happens, the 20 million shares issued will have been a very expensive way to acquire a non-performing asset, and existing shareholders will be left with a diluted stake in a company that has essentially burned through a significant portion of its equity. My biggest concern is the dilution from issuing 20 million shares into a company with a relatively small market cap. This move significantly increases the supply of the company's stock, and for it to be justified, the mining assets need to deliver, and deliver big. What I am actually looking for is any further news or reports that provide more detail on the actual geological potential of these Tanzanian mining properties. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe for more. The Discord link is in the description.